Welcome, Pat. Happy Friday. Happy Friday.
Hey, Rick, how you doing, buddy?
We made it. We made it another week.
Yeah. No kidding. All righty.
Got so we're gonna go we're gonna take a look at current inventory. Then we're gonna jump into interest rates today, and then take a look at some Cromford data, and then I have some information on new construction. So that's gonna be our little our little walkthrough today. So see what's going on. So if you're ready, let's get started. Right off the bat, for a Friday, this is even lower than last week, Pat. 5,175 homes on the market.
Wow.
Ooh.
Really?
Now it's not going to go down tomorrow. Tomorrow it'll go up. And
We must be
7-day
boring the
moving
hell
average.
out. Are we boring the hell out of viewers? Our millions of viewers, you think?
Well, that's part of the goal. But here, the blue line's higher than the red line. The red line's number of homes under contract, and the blue line's the number of listings that come on. I got a little more detail than that as we get rolling, because here it's interesting that right now our active listings are down 5.9% versus last year and 15.6% lower than last month. That's pretty wild. Under contract, now here's the part that's interesting. Under contract, which is total, which means pending and contingent and everything, is down 2.7 versus last year, and down and up 20.8% versus last month. So we're down versus the year, but we're up versus a month. And prices are up 2.5% versus last month. Now, we started talking about the Cromford Index showing a little uptick here in December, and it always predicts a price increase. And sure enough, here we are. We're up 2.5. It looks to me like it's going to be thanks, Derek. It's going to continue that way through February and March. We're going to see, I think, between 2 and 3% of the price increases. The other thing that is noted is that total contracts, it said here are down 2.7%, but the number of pending is up. And what that means, agents are immediately taking contracts and just listing them as pending. They're not showing them as under contract, accepting backups. They're just dumping them right into pending right away. So that's where the difference in those numbers come from. So it's kind of a subtle little difference, but that's one thing that's going on the market now. So Pat, what's going on with interest rates? There was good jobs report today.
Yeah, it was a good jobs report, 467, I think, 1,000 jobs. Obviously with the Omicron, they were expecting a lot less, but am I sharing my thing here? Let's see here. There we go. This was the rates today. Let's see, where's my thing here? Right here. You saw down 41 in terms of basically price. This is an inverse relationship. So if they're down, rates are up. The 10-year treasury was up 8 basis points to 191. So we broke through 190. We saw it kind of resting before the jobs number. We busted out here. Rates right now are in the high threes, 4% range. I think people are obviously have to come to realization that we're probably going to be in this range. I really like in this. There's a chart. If I can, I should have shared. I won't share because I know our whole thing was to have charts up, and I meant to pull up this chart, but just this is where rates are, and I think I'll maybe pull it up next week and have it more chimed in. Actually, can you go? There's a news article in the home. No, in the home section of that. Go down. There's go down. Let's see here. Go down. Yeah, right there. Mortgage rates leap toward 4%. The highest they have that. Just hit on that headline, the 4%. Yep. And then does it show you a chart, Rick? Pull that up.
There's a chart here.
No, go down.
Okay.
Go down. Okay, yeah, yep, right there. Go to the max. The zoom on this chart. I mean, I think we're going to see. We see. Yeah, don't move. Yeah, I think we're going to see this slogging along like 13. I mean, you saw that. I think this it's going to be like 13 back. Right there, right there. That how they moved up.
Okay.
I think this year we're going to be this. My take now, kind of researching this stuff and following this. The rates. My guesstimation is this is just Pat McMaster's in Chandler, Arizona, but I think it's just going to be one of those. I was talking to another LO. He had a client of his put 30 offers on the house and they haven't gotten it. And he says, he goes, Pat, he goes, I don't know what you look at because you always have some great information. And he's been in the business 22 years. He goes, I always love your take on stuff. And I'm like, it was kind of impressive because the guy's pretty smart and he kind of gave me a good compliment. But I told him this is going to be just a year of sloshing around. This is going to be a sloshy year where I think, everybody's trying to predict where rates are going to be, where they're going to be in September, October. I think, we saw the high, we're saying, because rates went really from the high twos, low threes. They went, 3.125%, 3.25%, but then they busted through that 3.25%. They rammed up. They were up about a point. So they're all of a sudden they went from 3.25% to like 3 7/8, 4. And I think you're going to see this muddling around high threes, low fours. Obviously, if the Feds come out, now it's kind of talking about the Feds, increasing by half a point. If they do, I think they'll, you might see the market rates go up a little bit, but I think they'll back off because that news is already out there. But I just think overall, it's just going to be a sloshy year.
Well, the Bank of England raised their benchmark rate yesterday, and then the European Central Bank, she came out and said, yeah, they're going to raise rates probably by March.
Yeah.
So that news is out, us, but it kind of affected us.
Yeah. Well, it definitely affected us. Go back to that screen. I mean, that was right here where rates, that was the European side. And we, with the jobs market, we saw it bust out here. This is basically, I know that we jump around the charts, but this is the 10-year treasury, 190. Now, if it gets a 2, that means obviously if this chart's going up, rates, this is basically kind of the rates. This is a 10-year treasury, but 10-year treasury kind of tracks, mortgage rates for the most part, not not exactly, but gives you a trend. But I look at this whole chart, this whole thing here where we're based out, then we went up, and we based out. I think that's what we're going to see this year is, you're basing out. Now we're probably going to base along here for a while. The news comes out. I mean, because you take it out to March.
Well, did we freeze here? I think you froze. Okay, we're back now.
It's going to be just kind of a tiring, sloshy market. It's going to be a tiring market, because rates will go up to, low 4s, 5, 4.5. I don't think it's going to, personally, with the rates going up, people are still buying. I'm going to try to run some numbers next week. I'm going to try to do a comparison as far as, okay, at 450,000, because I was meant to do it, but I got busy with a couple of deals today. I'm going to run some scenarios. Okay, you're buying a $450,000 house. What effect does it have? From the difference in payment from 3.25% to 4.5, 5.
Well, it's having some effect according to the Cromford data, and it's showing that it's not affecting the higher end at all. But we are starting to see some buyer fatigue out there, and they're backing off, and that's a natural occurrence, which should help add more inventory. We are seeing more inventory coming on in the $400,000 to $500,000 range, $400,000 to $600,000 range, and extremely short inventory in the high end, places like Fountain Hills, North Scottsdale, and Paradise Valley. But it's not enough to affect price yet. You're still seeing multiple offers, and that's going to take a little while. So speaking of the Cromford Index, let's take a look. I found some interesting data that I want to share, and this is new listings by calendar month. So if I just look at this year, last year, you can see that January we got 9942. I'll make this a little bit bigger here. So 9942, and then it goes down in February, and that's what's happening. It's seasonal, right? 8808. Yep. But remember that 8808 for a moment, okay? Let me go back to 2005 and 6 and 7. So I'm going to try and get rid of all of these. It's it kind of lags a little bit here when I do this. So there's 2004.
Mm-hmm.
Okay. 11,000 listings. Okay. And I'm going to add in 2005, take off. So those 2 years right there. So we're comparing 20 and 21. We had what did I say? 7,900 or 8,000?
80,
So,
80,
and here's 20,000.
8,088.
Okay. This is the run up before the big disaster. 2006, 14,000. 2006 and 2007, 28,000 compared to where we're at
8,000.
now. And if I were to go back and let's just compare 20 and 21 because they're completed years here. There's 17,000. So it shows you that we're so far below the inventory levels that we were seeing before the big crash. And when you start looking at those are listings by month, and then you looked at sales, which was tanking, we ended up with between 57,000 and 65,000 homes on the market. So the next thing I wanted to look at was new construction. And I pulled off some economic indicators here from the census, which is kind of interesting. And it's showing here, look at this. This is vacancy rate is down to 5.6% versus the fourth quarter of 6.5. This is why you see all this rampant investor traffic. The vacancy rate keeps going down. That's, you have this many apartments here and only 5% of them are empty.
Mm-hmm.
That's a good vacancy rate. Home ownership rate dropped from fourth quarter 2020 to 2021, but only by 3/10 of a point.
Yeah.
65.8,
That
65.5
that'll
versus
never drop
60.
that won't ever drop it. I don't think that number I think will always be a constant because
Yeah,
I
yeah.
heard something from from a more broker, real estate office broker. He, he made a good point because if you take 10 people that want to buy a home from a credit standpoint, he goes 7 out of 10 will have their stuff together to be able to get a home. The other 3 out of 10 just are never going to be able to be in a position credit wise, money wise.
That's
To
an
buy a
interesting
home.
number to follow too, though, because remember in the run up to 2008, that was the number that they were trying to budge. That was
Yeah.
the number that
Yeah.
the Congress said,
Exactly.
we've got to get that home ownership rate up to 80%. And at one point they did, but they did it by letting anybody get a loan.
Yeah, exactly. So
So
that's
it's not
why.
unhealthy for it to hang in the 60s, is it?
No, I mean, would you say?
It's not unhealthy for that number to
No,
remain in the 60s
no. If it gets to
for the
80,
market.
then you know that anybody and everybody's owning a home. And a lot of these people that, unfortunately, I mean, there's some people out there that, and he referenced it too. He goes, if you have 10 of your buddies, he said he said kind of this way, if you had 10 buddies of yours, you got the 7 out of 10 that have got their stuff together, their crap together to buy a home and, has got, this or that. But then you always got the 3 buddies that are just kind of out drinking all the time and never settle down. And
Yeah,
that's
yeah.
kind of true. I mean, it's, you're going to have these people that just never, they don't want a home or never really get serious about it.
Well, construction spending in December nationally only rose by 0.2, 0.2% versus November 0.6. And you can get into a lot more. You can really get into the weeds here. New residential sales up 11.9 versus November 11.7. And
So this is what you do on the weekends, huh?
I got something to do all day tomorrow. So I got but here's another number here to top state and metropolitan core based statistical area, CBSA. Everything's got to be an acronym, right? So
Yeah.
we had so many acronyms when I was at my last sales job. I sent my team an email that was all acronyms, ASAP, and they understood every word of it. Arizona, total units for new construction, 45,680 in 2019, 60,000 in 2020. That's a change of 29.5%. 5%. So we're finally starting to build. Now, I don't know if it's enough yet, but here's an interesting thing. And this is off of one of my sites where you can actually, and the link is in the body below, and you can look at new construction. So I pulled up Queen Creek because that's where a lot of this new construction is going on, right? And check this out. So it shows all these by Toll Brothers, the Voyage Collection, Archer, and the prices are over here, 933,
Jeepers.
789. But see this little thing here? That little grayed out spot?
Mm-hmm.
Well, that says status. It means they're building. The ones that aren't grayed out, it means they're planning. They're planned. They aren't building them yet.
Oh, wow.
So I thought that was interesting. But you look at these prices though.
Jesus.
458. These are base prices. 465. 465 base price at 2193 square feet. So there is a lot of building that's going on out there. And one of the places that just came up now again is down here in Maricopa. This is Meritage Homes just scooped up 300 acres to build. How many homes they going to put down there? 696 homes in the 340s to 450 down there in Maricopa.
Huh.
They're gonna need to do something about that road, Pat.
That road is terrible. That road, I mean, they're gonna have to make it. It's 2 lanes. They're gonna have to make it 3 lanes each way. They got the land to do it. It's crazy.
Well, you have to negotiate with the tribe to be able to expand it. So
Yeah.
that's what took them so long to get that 202 loop to go around South Mountain, right?
Yep.
Negotiating with the tribe to get done. I'm not insinuating the tribe is difficult. It's just a lengthy process.
Yeah.
So, and another thing I ran into, and you've heard of next gen homes, right?
Yep.
They're popular now because a lot of baby boomers bring in their aging parents. And I think one of the best builders in the East Valley of next gen homes is Lennar. And I found one here, and just to show you how it's laid out. So this is your entryway. So if I turn it around here, there's your front door, right?
Mm-hmm.
Okay. Now you come in the front door and you turn right, and here's a bedroom here, a bathroom, but then check this out. Living room and kitchen.
Wow.
And
That's
a separate
amazing.
entry right there.
Wow.
That's what next gen living is all about. Your parents can have their own place. It's like a studio apartment inside your house. Now you go back out and
I mean, if you think about it, those would be popular even just to buy, and you could rent that damn side out.
and people do that. And this is just a beautiful home. Of course, the model
Yeah.
homes they're always that way. But I thought, and I sold the next gen home down in Chandler, probably about 4 years ago, maybe 5 years ago, and they're very popular. I mean, we had multiple bidding wars on that thing because there just aren't any out there, but they're a convenient.
I wish I would have had that.
home to have.
My parents had one, so when I came home drunk on my good old days, I could have just snuck in the side door.
Yeah, I mean the side door. I mean, I grew up in an old wood house with my brother, and I never forget. My brother got in trouble. My mom was just screaming at him the next morning. She says, "You came home drunk," and he goes, "What do you mean I came home drunk?" He was in high school. She goes, "I heard you walking up the stairs." He says, "We were out catching shrimp. I was wearing my boots." "No, you came home drunk." They're like, we laugh about that to this day. It's like, whenever I see Randy wearing boots, I go, "Are you going drinking?" So,
That's funny.
but it's fun. Anything on the radar for next week? I know with listings and stuff, it's just going to be more of the same.
No, I mean, make a quick note of it. The lenders are taking off some of their COVID overlays still in terms of self-employed borrowers. The second home, there's still some lenders out there are still allowing price for second homes, but that's going to start kicking in. I think there's a couple of lenders still left that allow before they have the second home pricing hit. It's going to be interesting to see, the next couple of months, how that pricing hit does kind of affect second homes. If there's, obviously we'll keep the viewers, in tune as far as if we see any, news articles or data that comes out, say, hey, second homes have been affected, by that pricing increase. Cause it's a pretty substantial, it's about a $400,000 home. It's probably about a $15,000, $16,000, your rate will go from the high threes pricing equivalently would be about 5.25.
Wow.
So it's going to
Well,
be
keep in mind that right now 27% of our market is cash,
yeah, yep,
and the iBuyers are still. They Open Door came out, and you look at their numbers, and they have hit their target acquisitions and sales that they said they were going to do when they issued their IPO and they went public.
yeah,
Now the key is, will they be able to start making money?
yep,
So Zillow's out of the picture. The competition's less. Maybe they can finally start working on their business model to make money, but that's permanently changing how homes are bought and sold now. Well, I want to do a deep dive into that in a couple of weeks. I want to talk about where real estate could go because, right now you have, when you list a home, the seller determines the commission that's paid both for the listing agent and the buying agent, right?
mm-hmm.
And the feds want to decouple that. They want to take that commission that the sellers are paying, and they want it to land solely on the buyer. Well, what is that? What is that going to mean? So I'm gonna take a look at the possibilities of what might happen if that happens. That's probably going to take a couple of years, but
Yeah,
if I'm a bet man, they're going to do it.
yeah, no, definitely. So I think we're gonna next week. I mean, I don't see anything else on the horizon. I mean, just we'll keep abreast of the rates. I mean, obviously, I think the rates are going to settle down a little bit now that we got the news out. The Feds. It's not going to be a surprise, but like you said, my kind of takeaway from looking at this stuff the last couple of weeks, I think it's just going to be, a sloshy market. It's just going to be one of those put your hard hat on and battle through this year. I mean, with real estate agents, I mean, obviously the inventory is low. On the mortgage side, you got rates going up. People should be pre-qualified on the higher end, and it's going to be a interesting year.
Yeah, don't expect pricing to come down. There isn't any indication
No,
that even with the rate increase. In fact, I shared a chart on a video I made yesterday, live stream I did yesterday afternoon. It'll be relaunched probably tonight or tomorrow. That showed the inflation rate versus the home appreciation rate, and home appreciation has always been above inflation,
yeah,
except in 2008. But even then, that was just a 1 or 2 year anomaly. But as a rule, it's, you'll have an inflation rate of 7%, home prices accelerate by 9. So the interest rates going up, the everybody's looking now and saying, boy, are we going to have to clamp down as hard as Paul Volcker did in the late 70s? And I don't think so, but it really all depends on the rest of this year, doesn't it?
yeah, it does. I mean, the thing is with them, raising rates, it hasn't been too many times where they've raised rates and they stop, or they stop their mortgage-backed security market. Usually they're doing one or the other. So that's why I think it's going to be it's going to be a tough market because, like I said, they're going to be doing both. But if they see themselves getting too ahead of the curve, and maybe they tap the brakes a little bit. But their
Yeah, and
job
I
is
think
not
they're
their job is not to their job is to do the Feds, not to regulate housing.
yeah.
That's what they said.
Yeah, their job is to keep the currency strong, and they, I think they kept mortgage-backed security purchases going on for too long, and that's why we're at where we're at.
Yeah,
But that, hindsight's 2020. They were working hard to keep everything from collapsing, and that's one of the unintended consequences. The economy kept going, everybody survived. Our debt is now $30 trillion, and house prices and assets are through the roof. So we're from the government. We're here to help.
yeah, no kidding. So,
All right,
all
Pat.
right,
We'll
man.
have a fabulous weekend. And oh, my puppy dog's doing much better today.
Good. He's off the ventilator. Good to hear.
Yeah, that's for sure.
I got one closing note. I just got some news. I'll share with you. I mean, for what it's worth, I've been working on this loan the last week, this USDA loan, and I've been working on this thing for this lady. And she changed jobs 2 weeks ago,
Ooh,
and I a week and a half ago, I got, ran it through the lender and through the system called GUS, government, the government underwriting system for USDA, and I wasn't getting it approved, but I had an interesting conversation with the underwriter about a couple of days ago, and I told her the plight of the borrower, what's going on. I'm not going to get into the details, but she's been in a tough relationship. And well, I tell you, this underwriter, we sat and talked. I told her the story of what was going on with the borrower. And she says, you know what? I'm gonna dig into this file and we're gonna get this woman approved. And she was on a tightrope, but she just called me about 10 minutes ago when I was on the phone, just before here. And she goes, you know what? I got it to go.
Wow, that's great news.
So, I mean, we were battling last week trying to get this woman, just try to tweak the file, make sure that everything was right. And she went from not being approved to approved. And she's, there are underwriters out there that really care. This one lender, Union Home, shout out to them. I mean, they've been a fantastic lender. She was just listening to the story of what happened, and she could see what I was presenting to her. It kind of jived with the whole story, and so it just, I just want to kind of use an example that underwriters see the information, but they don't know the whole story. But I took the time to spend about an hour on the phone with her to say, hey, this is what happened. This is what happened. And she understood the story. And, she's like, okay, I can see the story. I can see the forest through the trees. So got her approved.
Yeah, that's that took some real legwork on your part. That's the power of conversation, but it's nice to have somebody on the other end that's going to listen.
Yeah. You got it. Just, so you definitely, it does, I've had that happen a couple of times where, I just tell the story about what's going on with the borrower, because all the underwriter sees is papers and numbers. That's all they see. They don't know what's going behind. Like, what happened? Why did this happen? Or why, I see this on the credit report. Why'd that happen? And I explained it to her. She goes, okay, I can see that. Yep. That makes sense. So pretty amazing.
And they just have to put in notes to the file, right?
Yeah. Yep. So, a lot of layers of explanation, and got it done. So,
well, that's a good way to end the week.
Yeah, no kidding. So, all right. Well, I just want to end on that good note. So have a good week.
All right. Sounds like a party. Have a good one. Take care.
Talk to you later. Bye-bye.